Hey traders, welcome back to FourTrades.com. Today we're diving into a powerful strategy that combines multi-time frame analysis with psychological levels to help you refine your trade entries and improve accuracy. This method can drastically boost your trade performance by providing better context and risk management. Whether you're a beginner or intermediate trader, this approach is a game changer. By following this strategy, you'll learn how to assess the market context from higher to lower time frames, ensuring that you're trading in line with the trend and at key levels. Let's jump into it. First, let's talk about multi-time frame analysis. In simple terms, this approach means looking at multiple time frames to get a complete picture of the market. Today, we're focusing on four key time frames: the daily, 4-hour, 1-hour, and 15-minute charts. Why is this important? By starting with the daily chart, we can understand the bigger picture, whether the market is trending or ranging. As we drill down into lower time frames like the 4-hour, we refine our understanding of key levels and identify potential trade setups. The 1-hour and 15-minute charts help us pinpoint precise entry and exit points. Let's start with the daily chart. Here we want to identify the overall market trend. Is the market in an uptrend or downtrend? Tools like trend lines, the 50 EMA, exponential moving average, and candlestick patterns help us with that. On this EUR USD chart, we see an ascending wedge, which is a bullish continuation pattern, but notice how the price struggles at the 1.11564 level. This is a key resistance zone. We also mark significant support and resistance levels, such as the 1.10485 area. These levels are crucial because they guide us in identifying high-probability trade setups. Now we move to the 4-hour chart to refine those key levels we identified on the daily chart. This is where we double-check the market structure, whether it aligns with the daily trend. We also look for psychological levels, which are round numbers like 1.1000 or 1.1050. These levels often act as barriers where the market might reverse or continue. On the 4-hour chart, we see price consolidating near the 1.10400 zone. This could either be a sign of accumulation before a breakout or a potential reversal. Keep an eye on how the price reacts here. The 1-hour chart is where we start fine-tuning our entries. We want to look for entry zones where we see confluence between psychological levels, trend lines, and momentum indicators like the RSI or MACD. For example, at the 1.10263 level, we could see a potential buy setup if price action confirms with a bullish reversal candlestick pattern. Remember, price action is key here. A breakout above or below significant levels often signals the next move. Always wait for confirmation. The 15-minute chart is where we get precise with our entries. At this stage, we're looking for price action confirmation, such as a strong bullish or bearish engulfing candle near a psychological level. However, be cautious. Lower time frames can have more noise, so always cross-check with the higher time frames. Once confirmed, we can set our stop loss just below the previous low or high and our take profit based on the daily or 4-hour resistance levels. So what exactly are psychological levels? These are round numbers like 1.1000 or 1.1050 that attract a lot of attention from traders. These levels are often where the market hesitates, making them ideal for trade setups. When psychological levels align with other key support or resistance zones, they become even more significant. This confluence is where we find the highest probability trades. Now let's talk about risk management. Always adjust your position size based on the proximity to psychological levels and how volatile the market is. A favorable risk-reward ratio is crucial. For example, if you're risking 20 pips, aim for at least 40 pips in profit. This way, even if you only win half of your trades, you'll still come out profitable in the long run. Let's put everything together with a practical example. Here's a recent trade on EUR USD. Starting from the daily chart, we identified a resistance level at 1.11564 and a key support at 1.10485. On the 4-hour chart, we refined those levels and spotted consolidation near the 1.10400 zone. On the 1-hour chart, we saw price action confirming a potential buy entry at 1.10263, and on the 15-minute chart, we had our precise entry point. With a stop loss just below 1.1000, this trade had a solid risk-reward ratio of 1 to 3. Before we wrap up, here are some common mistakes to avoid. First, don't overtrade on the 15-minute chart. The lower time frames can be noisy. Second, always align your trades with the higher time frame trend. And third, never neglect risk management, even when you're confident in a trade setup. If you like this video, make sure to hit the like button, subscribe, and leave a comment below. Thanks for watching.